Decision day for the Fed. Futures higher this morning ahead of the highly anticipated Federal Reserve announcement. The central bank will decide whether to raise its key interest rate, its short-term interest rate. That would be the 9th rate hike since late 2015. Joining us now, ConnectOne Bank Chairman and CEO, Frank Sorrentino. Frank, good to see you this morning. Thank you for being here. What do you expect from the central bank today? I
don't think there's going to be any surprise today. I think there'll be a rate increase. I think the Fed has telegraphed that very well. The Fed is really looking to get to a neutral stance. People are getting very excited about the fact that interest rates are rising, and they think it's rising because of the strength in the economy. It's really more that the Fed wants to get to neutral. It desperately wants to get to this place. I think what's going to be interesting, though, are the comments after they make this raise as to what are they going to do in 2019.
But what is neutral is one of the central questions. And quite frankly, it looked like a lot of investors got it wrong listening to Jay Powell when he said in that last speech that he gave, where it's close to the neutral range. But the neutral range, based on the Fed estimates, is 2.5 to 3.5. And we're starting today, before this rate increase, potential rate increase, at 2 to 2.25. So if you're talking about 3.5 being a neutral rate where it doesn't stimulate the economy or doesn't slow it, that's a long way to go.
So, Dagan, I think he did walk those comments back
through the Wall Street Journal, by the way.
So he did say neutral did start at 2.5. We're 25 basis points away. I do expect additional rate increases in 19, but not the 4 that they predicted.
The interesting thing, Frank, about Jay Powell is in October he said, we have a ways to go until we get to the neutral rate, and then in November flip-flopped over to we're close, we're there. The thing that happened in that month was, well, some of it was the data, but a lot of it was the markets. I guess the thing is this. What's going to impact lending? If they keep raising rates, do you think it's going to pressure consumers? What are customers of your bank most concerned about here in terms of their credit and in terms of what they're doing and their money?
So again, I think if you look at the economy, strip out all the news, strip out the Twitter feed, strip out the headlines. The local economy, the economy that ConnectOne Bank operates in, is very strong. People are optimistic. People feel good about the regulatory environment. They feel good about the employment market. They feel good about, oil prices. They feel good about a lot of things. Interest rates, however, force you to start to think about your business differently. And you have to think about what impact that's going to have, especially in businesses that rely upon financial instruments.
I'll just point out really quickly that small business optimism, in fact, it's off highs, but it's still good, pretty well.
Yes.
It's one of the stronger parts of the economy.
Consumers spending like crazy, right? This Christmas season is going to shape up to be one of the best. So I think the backbone of the economy is good. Interest rates for the first time in almost 10 years are something we have to think about. We didn't think about them before. They were zero. They had no impact on your decision. You could buy a home and your mortgage payment was less than the rent for an equal-sized home. That's not the case anymore. Now you have to actually think about how does this play into the economy. And I think, again, this notion that interest rates are moving to a normal place. And by the way, in my lifetime, a 4.25% mortgage rate is not normal to me either, right? My first mortgage was 13.75% back in 1984. But
even at an 8% 30-year fixed rate mortgage, a house that cost $2 million in New Haven, Connecticut, when mortgage rates were at that level in the early 90s, cost like a few $100,000. It's the difference between a $2 million house and a $400,000 house. That is, so
look,
again, that's the danger.
Affordability is definitely going to be impacted here, but maybe it should. Right? Housing prices were increasing without the increase in demand, just from speculative nature because interest rates were so low. That's the classic formation of a bubble. And so that's not going to happen. And I think that's a good thing for the economy.
Whatever Jay Powell does and says today, he's going to get criticized. This is a job I would not want. Do you think Janet Yellen should have just stayed on as head of the Fed? Because she had more experience in navigating that words matter and just dealing with all of this. Do you think Trump is maybe saying, well, maybe I shouldn't have appointed Powell?
I really don't know whether it would have been better or worse, but you have to hand it to the Fed in general. Under all of the heads of the Fed, through to today, right, starting with Bernanke and through to today with Powell, they've really navigated quite well this economic environment that we've been in, from almost the worst since the Great Depression to a pretty hot economy as we entered 2018, and I think are doing the right thing. And of course, they're being criticized, and that's just natural. But I think they are looking at data. They are data dependent, and they are looking at what's going on. It is not political.
Well, and
they're
the concern is the
those,
future, not the present.
And maybe the
present
words,
data is fine.
right? And maybe the words they're picking, and I know they're still trying to find their way. Are they speaking too much? Not speaking enough? We've had different chairmen with different points of view there. But I think at the basis of it all, the Fed is doing an incredible job of navigating this economy.
I'll point something out, though. If it was Janet Yellen still there, and Janet Yellen was didn't get the job based on President Trump's pick, he would probably be hammering her even more than he's hammering Jay Powell, because it's not his pick. And if he had picked maybe Kevin Warsh or John Taylor, they would be a lot more aggressive than Jay Powell is being. And Jay Powell even had the gumption in recent speeches pointing out the Fed's fallibility in previous eras. As the Wall Street Journal wrote yesterday, talking about it's time for a Fed pause, they said a marked contrast to the all-knowing condescension of Bernanke and Greenspan. So this is a different Federal Reserve chief, maybe for the better.
Right, and I think if you look at the past few months, though, since he spoke, as Michael pointed out, the economy has changed, at least from a market perspective, quite a bit. So, I mean, Yellen had predicted that she was going to move 4 times. She wasn't able to do that. We can't necessarily look at what he said in the last meeting and think that that's indicative for what happens today, because the market globally is just changing so much quicker than I think anyone expected.
But look where the U.S. economy is relative to the rest of the world. We're in one of the strongest positions I think we've ever been in.
So we're going to grow.
The Fed has played a very important.
We're going to grow.
Well, we're taking on fights that maybe we needed to take on, before today.
I want to point out we're going to grow this year, likely the U.S. economy at 3% or more for the whole calendar year. That never happened under President Obama. Not in any one calendar year. It hasn't happened since I think 2005. That's how long.
Right. So the market's getting excited about maybe a little bit slower growth than that. It's not that we're going to fall back to a recession. People are talking recession, and I don't understand it. The fundamentals of the economy are so strong. You're right, 3% growth. That's terrific.
Well, they're talking recession because they think the Fed's going to foul up and keep being aggressive.
My bet would be that they don't.
I want to get to this story. New changes coming to Experian. The credit reporting firm will begin factoring in some consumers' cell phone and utility payments to their credit reports, a move that will help boost people's credit scores and increase loan approvals. Consumers can opt into the service by allowing Experian to track their monthly payments. What are you seeing in terms of consumer loans right now, and will this make a difference, you think?
So I certainly think that we're using lots of tools today that we didn't have at our disposal before. And so anything that can actually help us to credit score a client and not use, old technology to do that, I think is a positive for the consumer.
Right. And people, what bill do you pay first? It's really your phone and your utilities, because you need your cell phone and you need your lights on.
Well, interesting. We're using lots of other tools today that we never used before, right? Even social media tools to be able to evaluate the creditworthiness of a client today. So there's lots of opportunity in the marketplace today with fintech, with lots of. We're not doing that specifically, but in the financial industry, there's definitely been a move to change how we're thinking about credit and what is good credit and what's not.
Yeah, but 2 companies I really trust right now are Experian and Facebook. Just to put that out there.
Yeah, exactly. You're in the business of basically protecting people's credit, and whoops. Frank, good to see you.
Great to see you.
Frank Sorrentino.